An oil shock just became a copper crisis, a chip crisis, and a grid crisis, all at the same time, and almost nobody connected the dots. Most of what you heard about the Strait of Hormuz closure stayed on the surface. Oil prices spike. Brent goes vertical. Central banks respond. That's one order deep, maybe two. But an Australian entrepreneur named Craig Tyndale published a cascading analysis last month that goes 12 orders deep. 12. And the team at Capitalist Exploits called it the most important supply chain paper they've read this year. Because by order 3, the oil shock isn't about oil anymore. It's about sulfur. Sulfur becomes sulphuric acid. Sulphuric acid is how you pull copper out of the ground in the Congo. And copper is how you build every transformer, every cable, every piece of grid hardware the modern world runs on. When you see how fast one broken link becomes 10, you start to understand why the smartest money in the room has been quietly repositioning for months. There's a specific number in this analysis, a number about Taiwan's energy reserves, that should make every AI investor deeply uncomfortable. I'll get to it. But first, let me show you the machine that just broke. Here's how to think about what Tyndale mapped. Picture your house. The lights work because of wiring. The wiring is copper. The copper was pulled from rock using acid. The acid was made from sulfur. The sulfur came as a byproduct of refining a specific kind of oil, sour crude, from the Persian Gulf. That oil moved through a 21-mile wide corridor of water. Every link in that chain was optimized for maximum efficiency and minimum cost. No slack, no backup, no warehouse full of spare parts sitting somewhere just in case. We spent 40 years engineering redundancy out of every supply chain on Earth because redundancy costs money. And for 40 years, it worked until it didn't. Now, look at the map of global shipping routes, the one showing every major maritime choke point and the volume flowing through each. The Strait of Hormuz carries more energy tonnage than any other corridor on the planet. And when Tyndale's analysis walks through the cascade, what emerges is that this isn't just an energy choke point, it's a chemical choke point. Qatar's Ras Laffan facility alone produces 10,000 tons of liquid sulfur every single day. That's roughly 8% of global seaborne sulfur supply from one facility. Remove it, and you don't just lose fuel. You lose the feedstock for the acid that extracts the metals the world needs for everything else. The Capitalist Exploits research team puts it plainly. The central myth of the last decade is that digital civilization floats above heavy industry, that the cloud is exempt from the physics of copper, sulfur, and voltage stability. But here's the thing nobody wants to talk about. The cascade doesn't stop at metals. It reaches something much closer to your daily life, and I'll show you what that is in a moment. Let me give you the numbers so you can feel how fast this moves. Order 1. A 17.5 million barrel per day structural deficit opens within 2 weeks of closure. Saudi Arabia and the UAE have pipelines that can bypass the strait, but those pipelines together handle maybe 5.5 million barrels per day under the best conditions. The gap between that and 20 million is not a rounding error. It's the number governments are trying not to say out loud. Order 2, sour crude from the Gulf is the world's primary source of byproduct sulfur. When that flow stops, roughly 8% of global seaborne sulfur supply vanishes overnight. Most investors couldn't tell you what sulfur is used for, which is exactly why Order 3 matters. Look at this flowchart showing the copper and cobalt extraction chain. and its disruption stages. Sulfur becomes sulphuric acid. Sulphuric acid is how you extract copper and cobalt from the ore bodies in the DRC and Zambia. The DRC alone imports over 500,000 tons of sulfur a year. When seaborne supply disappears, force majeure declarations sweep across the copper belt. Spot acid prices there reach $700 a ton. And here's the number. The DRC and Zambia produce roughly 1/6 of global copper and over 70% of global cobalt, both extracted using acid-dependent processes. 3 orders into what started as an oil shock, you're now staring at a copper crisis. And copper, as you probably already sense, touches everything. But the order that should truly keep you up at night is Order 5. It involves a specific island and an 11-day countdown. That's next. Here is where this stops being abstract and starts hitting your portfolio. Taiwan imports between 95% and 97% of its energy. Qatar supplies roughly a third of the island's LNG, and Taiwan's statutory LNG reserve is 11 days. 11. Look at this chart comparing LNG emergency reserve days across Taiwan, Japan, and South Korea. Taiwan sits at the bottom. TSMC, the company that fabricates the advanced chips inside every AI server, every data center, every NVIDIA GPU, accounts for nearly 10% of Taiwan's total electricity consumption. When Taipower's grid goes into rationing mode under energy stress, voltage sags violate the semiconductor fabrication tolerances that TSMC's fabs require. Historically, a single voltage event can scrap tens of thousands of wafers. Now layer on Order 4 and notice how the pattern compounds. Siemens Energy's transformer order backlog sits at 146 billion euros. Large power transformer lead times have stretched from 50 weeks to 120 to 210 weeks. The bottleneck is a specialty steel called grain-oriented electrical steel, where the US has a functional monopoly through one producer and multi-year qualification cycles to scale. The grid hardware was already in crisis before any of this happened. The capitalist exploits team has been positioned in energy and commodity infrastructure precisely because of these bottlenecks. And the research from Tyndale confirms what they've been saying for months. The AI capex projections that Wall Street is banking on require copper, transformers, stable grids, and uninterrupted silicon. Every single one of those inputs now runs through compromised supply chains. The hyperscalers committing hundreds of billions to data center buildouts are writing checks the physical world may not be able to cash. But there's a question that goes even deeper than chips and data centers, and it involves your kitchen table. So, where does this leave you? There are really 2 paths. Path 1, the Hormuz disruption, resolves quickly. Insurance comes back, tankers move, prices settle, markets breathe. But even in this scenario, the fragility has been exposed. The world now knows that its copper, its cobalt, its fertilizer, its chip supply, and its power grid all thread through the same handful of choke points. Governments respond. Stockpiling accelerates. The US is already building a $12 billion strategic cobalt reserve under something called Project Vault. That's not subtle. Resource security becomes the organizing principle of the next decade. The companies that own physical production capacity, real energy infrastructure, real grid-critical materials, reprice higher, permanently. Path 2, the disruption persists. Tyndale's cascade plays out across harvest cycles. Roughly 40 to 50% of internationally traded nitrogen fertilizer originates from or transits the Gulf. One full harvest is enough to translate a supply disruption into structural food insecurity across North Africa and South Asia. Turkey's 10-year yields were already above 31%. Egypt runs on IMF life support and Gulf LNG. The cascade reaches order 10, 11, 12, and the framework stops functioning as linear analysis. Prices stop being discovered in markets and start being dictated by export bans and strategic hoarding. In both paths, the investors who do well are the ones who saw the physical world reasserting itself over the digital narrative before everyone else. So where do you find research that connects these dots consistently, not once, but every 2 weeks? That's what I want to show you. I told you the investors who win are the ones who see it early. This is how they see it early. The team at Capitalist Exploits has been positioned in energy, copper, and hard commodity infrastructure for months because the thesis never changed. The world spent 20 years underpricing physical production and overpricing digital narrative. The premium for resilience was priced at zero. It is not priced at zero anymore. And Craig Tyndale's cascade analysis explains precisely why. What the Capitalist Exploits Insider newsletter delivers, twice a month, is the research that connects geopolitics to supply chains to specific investment positions. Their Big Five trade ideas are screened for asymmetric risk and reward. Limited downside, outsized upside. They invest their own capital alongside their subscribers. No hype, no gimmicks, just the kind of macro intelligence that Wall Street won't touch until after the price has already moved. Right now, paid subscribers are seeing the specific names across energy. Copper miners with ore bodies that are not acid dependent. Fertilizer feedstock plays and the short side of the AI build-out trade. You're not seeing those names. You're also not seeing the portfolio positioning or the framework that ties it all together. The Insider newsletter, plus the full asymmetric investing course, is available at the link in the description. The link is in the description. Don't miss the next one.